Well, the dust hadn't settled on election night or early morning before bond yields starting to rise. And of course, with rising yields comes rising mortgage rates. Diana Olick on what the spike means.
Thank you, everybody.
As President-elect Donald Trump met with leaders in Washington today, investors around the world continued to back out of the bond market, which in turn pushed U.S. mortgage rates, which loosely follow bond yields, to their biggest two-day gain in 3 years.
In terms of actual interest rates, we moved a quarter of a point higher in 2 days, and that is relatively unheard of. It's the sort of thing we can count without using any of our toes, going back at least a decade. So it's definitely a big spike.
The average rate on the popular 30-year fixed mortgage is still historically low, below 4%. But the increase will definitely cost buyers in their monthly payments. It could actually keep some buyers from qualifying for a loan. Rising rates also just plain scare buyers.
Psychologically, we feel like 3.875 is a much higher rate than 3.625 if that's what we were looking at and that's what we had access to lock 2 days ago. So I think the psychological impact is fairly substantial.
On a larger scale, the rise in interest rates is also hitting the stocks of REITs, which invest in commercial real estate. REITs, which offer high dividends, are a low-yield play.
REITs are a derivative of interest rates and the economy. So if you have interest rates that are going up, that's going to send REITs down. The flip side of that is if the economy does better, that should help rent growth, which should help REITs.
It really is a grand irony. Donald Trump rode to victory on an electorate looking for a better economy and a better standard of living. But the initial financial market reaction made mortgages more expensive and could push rents even higher. For Nightly Business Report, I'm Diana Olick in Washington.